optimistic are you about Disney Plus and how well it'll be able to take on Netflix?
Well, look, I think the way to start off is you really can't frame the debate as Disney versus Netflix, right? I mean, Disney is going at this from a much lesser ambitious standpoint than Netflix. You know, Disney's not taking its movies out of movie theaters and putting them right onto the streaming service. So when Avengers Endgame comes out, it's going to be in the movie theaters. You're going to be able to go see it for months in the movie theaters, and then you're going to be able to buy it on DVD or download it on iTunes or buy it or rent it at a Redbox. And then eventually it's going to get 7 or 8 months after it's come out in the movie theaters, it will get to Disney Plus. But I don't think Disney's at the point where they're really going to go all in and put all of their content assets into the streaming service the way Netflix does. I think Disney's going to try to balance its legacy businesses and profit centers with kind of starting off into the streaming world. So this really isn't, I know it's been framed as Disney versus Netflix. This is really Disney adding a streaming service. Netflix is going to be the core service you subscribe to, and there'll be some subset of people that also take Disney Plus, especially people with young kids and families.
Paul, what are we expecting this Disney service to actually include? Like, will all of these legacy titles like The Lion King and The Little Mermaid, will you be able to watch those for free if you pay, you know, whatever the monthly fee is? Are you going to have to pay extra for even that?
Well, we'll have to see. That's certainly one of the things I think investors want to see Thursday is really what's going to be in the service, what the service is, the price point for the service is going to be, and what kind of investment they're going to make in original programming. So there's a lot of numbers around Disney Plus that investors want to get a better handle on. As it relates to the existing Disney content, arguably, you know, it's some of the best content on the planet. Bob Iger's paid up a lot of money to buy, you know, all the big studios like Pixar and Marvel and then Lucasfilms, and so he's going to get the benefit of that on the streaming service. But not all of that content's going to be available day one because Disney has licensed this content out to other distributors. So over time, most of that content will migrate back to Disney Plus. So one could argue it's certainly going to have very credible programming. The question is, relative to Netflix and maybe some of the other tech companies that are getting into the media business, will that be enough for Disney?
Now, Rich, talk to us about the addressable market here. This is a more family-friendly, kid-friendly market that they are hoping to reach, which, and I know it's not all about Netflix, is different from a Netflix market. How does that impact your outlook?
Well, I certainly don't think, I don't think a couple is going to come home on a Friday night and say, I want a Disney Plus and chill. I mean, I think that's going to be probably a bridge too far. But I do think from the standpoint of, look, they're going at PG rated, and below, family friendly, no sex, no violence. This is going to be really Disney, which is going to be really limiting. You think about Netflix, they're already at 60 million subs domestically. I think the kind of broad consensus view is they're moving towards the 70 to 80 million subscriber range. Basically, essentially what the cable industry has been. They're simply replicating the cable universe. This is going to be some subset. There's probably 30 million plus homes with kids under the age of 18. You've got some incremental fanboys and fangirls who love these franchises like Lucas and Marvel. Probably somewhere in the 30 to 40 million domestically. And, that's why I think there's been this view from consumers that there's this massive opportunity. And I think you've got to size what Disney's trying to do. They're not trying to create a service for everyone. They're trying to create a family service for Disney Plus, a kind of ESPN add-on service in ESPN Plus. Then there's Hulu, which is going after sort of this adult/family market, because even though they're saying it's more adult, most of the content on Hulu is pretty family-friendly, like it's last night's television from broadcast TV. And so I think what we're overall looking for on Thursday is how is Disney going to explain what their streaming strategy is? And probably most importantly, like every viewer of this show should be thinking about for Thursday, how does Disney continue to tell people to pay more for Disney Channel, pay more for ESPN, when they're literally going out with products and services that are away from the bundle, that actually kind of compete with the bundle? And how does that balancing work? Can they continue to get paid a couple dollars a month for Disney Channel, $8 or $9 for ESPN, while they go and attack the bundle through these new over-the-top services, which Iger has said very publicly is company's #1 priority now?
Right, and meantime, they're going to be losing licensing fees they currently get from companies like Netflix. Do we have any quantification, Paul, on how much Disney could be losing? Yeah,
this is a big number. This is, north of $1 billion when you think about the investment that they're going to be making in original programming, plus the lost fee revenue that they're getting from the Netflix of the world today and from other distributors. So, this is a major pivot for the Walt Disney Company here, and it's all on Bob Iger's name right here. This is his legacy right here as he tries to pivot the company away from what was the traditional cable bundle, which had been so good to Disney for such a long period of time, now pivoting to the streaming service. But because I think the clear issue from Bob Iger's mind is he knows that's where his audience is going, and he has to be a credible player there.
So look, Rich, there's a lot of excitement about this, but are you concerned that Disney could be almost cannibalizing itself here?
Look, being an arms dealer is a great business. I mean, the media industry has been an arms dealer forever, right? I mean, these are studios, content studios that sold to movie theaters, sold to the HBOs, sold to the Netflixes, the Amazons. There's more buyers than ever before. Trying to go in and do something you've never done, which is build a direct-to-consumer company. I mean, Disney doesn't know who the three of us are. They don't have what Emily's used to watch. They don't know what Paul watches. They don't know what Rich Greenfield watches. They don't know anything. They don't know that you go to the movie theater. So going in and trying to launch a direct-to-consumer streaming service is really hard. I mean, you look at the amount Netflix loses and how much they're investing in the... Remember, it's not just content. I mean, Netflix's marketing budget is $2.5 billion a year. Their technology spend is a couple of $2 billion a year. I mean, this is a very, very expensive endeavor to do and replicate. What I struggle with is why Disney feels the need to do this versus being an arms dealer of this incredible content to every single streaming platform out there. That seems to be the real challenge, is can they actually justify what they're going to spend, how many subs they're going to get, versus remaining an arms dealer, which has been an incredibly profitable business for decades. This is not just for Disney. You could say the same thing about AT&T, Time Warner, with their new strategy for Warner Media Group.